So holding on roughly with at about 22,040. Shibani Sircar Kurian is with us, Senior EVP and Head of Equity Research at Kotak Mahindra AMC. Shibani, good afternoon. Good to have you with us here. You know, later today on our next show, we're gonna put out a piece looking at earnings for the quarter, and about 52% of the companies were reported. I'm looking at the NSE 200 set, the most liquid names out there. And I'm just looking at how earnings have moved for this bunch, that is for FY25, based on beats or misses in the fourth quarter. There are more downgrades to 25 estimates than upgrades, at least in this sort of 200 bunch. And only, as I said, only about 104 odd companies have reported. Just your own sense, Shibani, and what you and your team are making of the earnings season, and what is it doing to forward estimates? Yeah.
Sure. Hi and good afternoon. So you're right. Earnings is what the entire market is focusing on, apart from some of the other events. But of course, when you look at earnings so far, the way we have analyzed earnings across our coverage universe, earnings at a broad level have been largely in line with estimates. So while you were talking about the 200 set of companies that you have looked at, if you look at just the Nifty 50, so far about 34 Nifty companies that have reported numbers. At a headline level, if you look at just the earnings have been slightly actually ahead of estimates. However, when you look at earnings a little closely and dig a little deeper, one factor clearly stands out, which is that domestic-facing companies and domestic cyclicals continue to contribute to the overall earnings momentum. While if you look at segments such as oil and gas, metals, etc., where earnings volatility continues to remain high. So even so far, if you look at the numbers that have been reported, sectors such as cement, autos, financials, and even to some extent capital goods clearly have contributed largely to the earnings. So far, if you look at the numbers that have come out, if you look at FY25 and FY26 Nifty earnings estimates have been by and large in line, and they have not been cut significantly. Of course, we still do have some way to go. But I think the premise that we have been working with where earnings is concerned has been that domestic-facing sectors and domestic cyclicals will contribute to earnings even in 25 and 26. And if you look at the numbers that have come out so far, that premise continues to hold true.
Okay, all right. Hi, Shibani. Good afternoon and good to see you. I wanted to ask you about the result of yesterday. That was SBI. The stock has already been a big outperformer. I was reading a Macquarie note. They are saying that the valuation gap between the public sector banks as well as the PSUs, it's the lowest we've seen in multiple years. And the suggestion is that maybe, in fact, the best of the good news is already in the price for some of these PSU names. And they've highlighted that for SBI, the deposit growth grew only by around 3% on a sequential basis, which is half some of those large private banks. What is your view between the two? It seems the PSUs have the momentum. Some of the private sector banks have the valuation cushion. Your take?
Yeah, so over the last year and a half, we've clearly seen multiples catch up where some of the public sector banks are concerned, primarily because there has been improvement in their return ratio profile, and ROAs, if you look at the pack as a whole, have merged closer to 1%, where ROAs earlier for the PSU pack used to be considerably lower, and that has led to the multiple re-rating. Now, from here on, our view on the sector is slightly different. We are looking at the sector in terms of those banks, both private as well as public, which have liability franchise, which should help them in terms of the current interest rate environment and help protect margins. So our focus is specifically on the larger banks, both private and PSUs. Here we believe that in this current environment where the rate cut cycle appears to have been pushed out a bit, margins will take focus and center stage. If you look at the numbers that have come out so far, it's clear that some of that margin pressure that we were witnessing is now seemingly bottoming out, where the cost of deposits have repriced to a great extent. And therefore, banks which have better liability franchise should be able to manage margins better. The second factor, which I think will be a key differentiator, will be how credit growth pans out. Our belief is that given the kind of regulatory actions that we have seen, there should be some moderation in terms of growth, especially where unsecured lending is concerned. And therefore, credit growth will also be a differentiating factor. From a valuation perspective, we do believe that the larger private banks and some of the large public sector banks still offer risk reward, which is in favor, especially given that we believe that return ratios should remain healthy. Credit costs are still under control, and there's been no major concern as far as asset quality is concerned. So therefore, from a banking perspective, we are looking at the larger pack, specifically some of the large private banks and few of the large PSU banks.
Shibani, the big positive earnings surprise this time has been the consumer staples, suggesting that there is a rural recovery. Were the staples a part of your portfolio before, and now, given the the data points that we are getting, would you start adding them?
Yeah, so Rima, I think a couple of months ago on your show, we discussed the same in terms of our view where some of the staples names are concerned. Now, while the numbers have not shown up any major surprise in a big way, pointing to a sharp recovery on the rural side, we have been of the view that the rural demand appears to have bottomed out. Our expectation is that slow and steady improvement should be visible where rural wages are concerned. Couple of factors here. One, inflation has now started to come under control, and food inflation should stay largely stable or moderate down. So that's number one. And secondly, the hope, of course, is pinned in terms of how the monsoons pan out, which could lead to better Kharif output, which again should be positive from a rural income perspective. If you look at the commentary that has come out from most of the companies, commentary does seem to suggest that there is slight improvement in rural demand, and therefore, that is reflecting in terms of the view on the FMCG pack as well. We have to caveat it to one extent, saying that the rural recovery will not be a sharp V-shaped recovery. It will be slow and steady, but definitely our belief is that the demand environment seems to have bottomed out where the rural sector is concerned.
Do you play the rural, slow and steady rural recovery demand via, say, two-wheelers like a Hero MotoCorp, or would you look at staples also, where hitherto valuations were a bit of a concern?
So we have played it across segments. So two-wheelers clearly has been one part of our portfolios where we have played the rural recovery, and that is something that is panning out fairly well. Here we believe that in pockets, valuations still do offer risk reward, which is in favor. And therefore, two-wheelers continue to be a part of our portfolio where we are overweight on. Within the FMCG pack, we have select holdings in the portfolio as well. We have looked at companies where valuations have now trended lower than long-term averages, and therefore those are some of those names within the FMCG pack which we have evaluated. We've looked at some of the financiers also, which could benefit in terms of rural recovery. So we've tried to play the rural theme across sectors, with two-wheelers being one large segment apart from the FMCG plays.
Okay. Shibani, finally, I was just thinking about some of the highlights of this week, and one of them was, of course, NCR real estate, right? We got to know that yet another DLF launch got sold out in some, I think, 3 days or 4 days or something like that. So, finally, what do you make of this entire pocket, real estate and the related plays, the ancillary plays on home improvement, etc.? It's already been a fantastic run, but the question is, can one still make fresh investments here? What would your advice be?
Absolutely, the real estate space has been one significantly strong performer, not just in the last quarter, but it's been something that has happened over the last maybe year and a half. The way we are now approaching this segment, of course, in pockets, real estate valuations appear to have caught up. But if you, as you rightly pointed out, the ancillary space, which is the building materials segment, that is a segment that has largely been lagging. Now, while we have seen significant growth where real estate sales are concerned, the same is not reflected where volume growth in segments such as, say, tiles, ceramics, etc. are concerned, where volume growth has still not picked up. In pockets, for instance, pipes, we've started seeing that already take place, where volume growth numbers are showing the improvement in demand from the real estate pack. But our belief is that building materials could be a segment where once the real estate sales come to a late stage, that could see an improvement in terms of growth, and margins should hold up because input costs have largely been under control. So the entire building material space is something that we have been evaluating. The second way that we have also invested in the real estate and ancillary space has been cement, where we believe that demand both from infra as well as real estate pack continues to drive volume growth. Pricing is something that we will watch out for, but consolidation in the sector should lead to better pricing behavior is what we believe. And therefore, cement, building materials is a segment where we have been fairly positive on.
All right, Shibani, very quickly on cement, large cap names or the mid and small cap?
So, as I was mentioning, cement is a sector which is seeing significant consolidation. We believe that the consolidation trends will continue. And in that segment, therefore, the large cap players will be better placed. And of course, we'll watch out in terms of how pricing plays out. But yes, large cap appears to be better placed vis-a-vis some of the mid cap names in the cement space.
Right, Shibani, good hearing your thoughts as always. Thanks for joining in and wishing you